let's move right on then and focus in on the India Ratings view, where they believe that delinquencies book may spike up in the next 4 quarters and that may exceed 5% for a few of the NBFCs. Prakash Agarwal is the Director and Co-Head Financial Institutions at India Ratings, joining in on the show. Thanks for joining in. Prakash, highlight the main concerns within your report. What kind of stress do you see to be within the lap book of some of the NBFCs?
Yeah, thanks. So what we're saying is that for some of the NBFCs which are more focused in urban areas and who are more into large ticket loans, you see on a statistical basis the delinquencies have actually doubled from what we have seen last 2 years back. So it's around 4.25 at the moment as FY16. Our sense is if the pace of delinquency continues to remain in next 2 to 4 quarters, we could see that for the pool of loans, the delinquencies could actually cross 5%. Now, if you see, and so the idea is what we're saying is that if you see the pool which has been disbursed in the last 5 years, almost all the pools are actually showing the delinquency trend at the same point of time. So what it suggests is that there is a cliff effect for these loans, and the LTVs may not necessarily be good enough shield for delinquency, while it could help in terms of recovery, ultimate losses. But the lower LTVs may not necessarily prevent loans from going delinquent. That's what our read is on this portfolio right now.
Okay, and since your report particularly highlights the risk of delinquencies on loan against property, is that also indicative of how the property market is still going through some pain? We haven't quite, despite rates coming down, we haven't seen the kind of semblance of stability in the property market as one would have hoped for by this time of the year.
Part of the reason why we are seeing this spike in delinquency is also because we have not seen any property prices rise in the last couple of years. Also, even the outlook for the property market is not very high. So if you see in the last couple of years, the stress was always there in this portfolio, but this was also kind of camouflaged by the balance transfer which was happening from one NBFCs to other, which would kind of not allow this stress to come to the fore. Now that with the outlook on the property prices is slightly higher, the top-up loan which could have been availed through refinancing, that has become somewhat tougher to come by. So SMEs cash flows were for stress for last 3-4 years, and we're not seeing that stress abating anytime soon. Now when the refinancing becoming tougher, increasingly become tougher, that the risk aversion kind of building up in the lender segment, that has kind of led to this stress coming to fore, and delinquency is starting to spike. Yeah.
You get me a bit more thoughtful about what's happening with the housing finance companies. Are they at higher risk then? I mean, because a lot of the housing finance companies in the listed arena have seen a fair amount of rally and interest from investors as part of the whole momentum that we see in non-banking financial companies, the listed stocks there. Is there more pressure on the bad loan situations with some of these HFCs than what meets the eye?
You also need to keep in context in terms of the loan against property could be a small part of the total portfolio of a housing finance company. The second piece is also need to understand which segment they are operating. So if a housing finance company is operating in, let's say, small to mid-sized LAP, probably that is not under so much of pressure compared to a large ticket loan. The third piece is kind of origination and practices which is being followed. So we can't generalize the entire segment in one piece, but I can say put in the sense that the NBFCs or HFCs which have been more dependent on intermediaries driven market for the lack of their infrastructure to generate that loan, and more in terms of more of the loan book which was built on the balance transfers rather than the origination. And the third piece is the housing finance companies which would have a larger ticket loan on the LAP book as a larger proportion. I think these would be some of the points which you need to factor in when you look at the portfolio level or the stress which could come in our housing finance companies. Yeah. So any company which would have disproportionately large share of LAP and that to very high ticket size and which would be largely driven by intermediaries, balance transfers, there could be some kind of risk or the NPLs we could see in coming times. Yeah.
So tell us, how does the SARFAESI Act come into play in the whole scenario? Is it going to provide relief, and how would you sum up the entire sector as to how it's going to tide through the stress that we're seeing?
Right. I think this SARFAESI Act which has come up, which will be applicable for loans above 1 crore, for this could certainly act as slightly beneficial, this may act. So we also need to factor in that the SARFAESI Act was always available for HFCs and for large number of HFCs and banks in that case. So this did not necessarily had a very, very great track record. Having said that, this act has been tightened now in recent times, and so it certainly could act as kind of, reduce in terms of incentive to, it could disincentivize the delinquency, and the recovery could be speeded up. But the actual impact of this we need to be still need to factor in. So we need to still say, how much this act actually impacts the overall stress scenario in this LAP segment. Having said that, what we are saying is that incrementally, if we don't see any much recovery in terms of the SMEs cash flows or repayment capacity, we could see the stress continue to build up. So the impact of this will be twofold. One is, of course, we see the kind of growth which this segment has seen in the last few years. If you see, the LAP segment was going pretty fast for the last 2-3 years, and then the bank stepped in, and so the urban market has become quite competitive. The competitive intensity in urban market is so high that we don't see many NBFCs surviving this segment or making risk-adjusted return for lending in high-ticket segments. So we see more and more smaller ticket loans and tier 2 loans where the competitive intensity is less and the pricing power is still there with NBFC. The growth comes from that, and the urban market growth for NBFCs is actually coming down. That is we clearly see fanning out in next few quarters for NBFCs. Yeah. Essentially,
penetration is a way forward, and we're going to be looking at that follow-up demand and perhaps more expansion in the market in tier 1 and tier 2 cities. Thanks very much, Prakash. Good report, insightful at that. Thanks very much for joining us with more thoughts on what you just put out to your clients. We'll keep it with macros, but global macros now. Geeta Gopinath, the economics professor at Harvard University, bets big on India. She says